Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Hectic Sunday for all of us. The market was reacting to the budget. It was open and, disappointed. That's the only word I can attribute to the budget this time. The STT hike came through, not taken very well by the street, nothing on LTCG, maintaining its fiscal discipline and the, fiscal deficit numbers. There was nothing extraordinary in the budget which could move the markets, and hence the market, sold off quite a bit. My favorite experts are here, Mohit Gang and Kirttan Shah, and my friends as well. Guys, thank you so much for spending your Sunday with me.
Thank you so much.
Couldn't have been better.
I'm sure you can have better Sunday plans, Kirtan. But okay, so let's start with you. On a scale of 1 to 10, what's your rating of the budget?
I think, look, like I and Mohit were discussing, the budget is very forward-looking, and hence, if you are looking at it from a 5-year perspective, I think the budget is decent at 6-7. But from a individual standpoint, I think there is nothing much to take away for a salaried middle-class India, right? But the fact also is because the last year they'd given such a large bump up for you to be able to save tax. I would have been really surprised had they done something this year. So I was not surprised that they've not done anything, but it's more of a 4 or 5 year view kind of a budget and not something that is going to materialize tomorrow.
Okay, let's be honest, right? I mean, we went in with zero expectations anyway.
Yeah.
So, and one market veteran said on TV, and I heard him, he said that, my expectations were anyway zero, and they disappointed even my zero expectations. I mean, that's on the lighter side of it. But Mohit, your rating on a scale of 1 to 10 and your key takeaways from the budget.
I would have rated it 7.5 had it not been a Sunday. So it's it's 7 because it's a
2
Sunday.
minus marks for Sunday.
0.5 deducted for being for coming on a Sunday. But yeah, jokes apart, I think on the fiscal side, on the prudence of government budget, on the numbers, and from a very long-term standing of the country in terms of maintaining the overall discipline and the glide path, I think yes, good marks. But as Kirtan rightly pointed out, on the very near term, short term, which all of us look forward to, there's nothing to actually hope and anticipate. Plus, the STT, I think, came in as a big dampener. Big dampener. I don't think so. The markets were looking forward to any bad news right now and are in a position to take any bad news given the way the global setup is right now and given the way Indian markets have performed for last 1 odd year. So I think from those counts, it's a bit underwhelming.
Okay, a bit underwhelming. That's a good way to put it. But, on STT, I wanted your views because there are two sides, kind of two streams of thought. One is, of course, the STT hike is negative because at a time when the market is already falling, you didn't need this. This was quite unnecessary. And, liquidity of the market will get affected. But the other side is that the government is very keen that they want to curb speculation. They don't want the youth of this country to be going and speculating in the F&O market and losing money. And hence the STT increase. So, Kirtan, what's the best way to read into this STT increase? And from a long-term investor standpoint, does it really make a difference?
I think from a long-term investor, it does not make any difference, right? This is more to do with people who are involved in the futures and market space, futures and option space, right? So be it a trader, somebody who's somebody who's using this for hedging and all of that. Those guys will slightly get impacted because, look, we have to take a step back. Why was STT STT and LTCG were supposed to not exist together.
Yes.
Right? But today what is happening is they're existing together, plus you are increasing STT, which is why this is a negative from that standpoint.
Over taxation. Basically.
Yeah, it is over taxation. But does it impact a retail investor like you and me or somebody who's investing in the cash market from a long-term standpoint? The answer is no. But what is the government trying to do? Like you rightly said, right? When you log on to a broker's app today, they mandatorily display to you saying that some 90% people lose in F&O and all of those disclaimers. You accept that, then you move ahead, right? So it's very clear from a government standpoint that retailer in India is actually losing money in F&O to a larger extent, right? We spoke about Jane Street making thousands of crores as net profit. HFTs, high frequency traders. Now what happens is when you increase these, right, it's a big negative for them, right? Because their cost goes up, and at the margins at which they were making money, they'll not be able to make money. So I think this entire ecosystem is to make sure that you do not try and, as a retailer,
Lose money.
punt in the FNO and lose money. And which is why they also introduce SIFs, right? If you want to make more money out of derivatives, give it to a professional who understands in the MF space. So long term investor makes absolutely no difference. Short term people who trade in FNO and use FNO as hedge, for that matter, Mohit rightly pointed out, arbitrage funds or hybrid funds who use arbitrage, right? Those are the people who will slightly get impacted. Long term impact is nothing for a
retail investor. But Mohit, it's interesting because higher tax on STT for FNO is like someone saying, I'm going to tax you on cigarettes so then you don't end up smoking. You will end up smoking anyway, right? And you will pay that higher tax on smoke. So trying to remove this addiction by hiking tax may not really serve the purpose. In fact, if anything, it will actually curb liquidity in the market, don't you think?
Look, I think it flips both ways around. I think government has been treating FNO as like a sin tax, the way they do it on cigarettes, which you rightly pointed out. And that's the way government went on gaming companies also, right? So the real money gaming companies, if you saw, government overnight came with a regulation and stopped everything, the Dream 11s of the world and everything. It just went up for a toss. So I think government is trying to curb this habit of youngsters in this country, or the real gig workers and the real wage earners in this country turning gamblers. And that's the big risk in the economy. Honestly, again, you can counter it and say there could be better ways and mechanisms to kind of make this foolproof. Rather than increasing the taxes, you can always put restrictions on age, on knowledge, efficiency, experience in the stock markets, liquidity, net worth criteria, and there could be many ways of curtailing them to start entering the FNO segment, right? Having said which, government has gone the tax route, which practically speaking in a capitalist mindset doesn't go very well. And I don't think so, as Kirttan rightly said, would be viewed very positively by FIIs, by high frequency traders and large institutional traders alike.
Okay, well, let's see how this goes. For now, the market has reacted negatively, but we'll only know in days to come. What else? What else is there on taxation? Of course, the memes all over the place are talking about how nothing has come through on taxation, personal income tax, etc. But that wasn't expected in any case. Anything interesting that stood out for you on taxation this time?
Yeah, I think out of nothing available, 2-3 things did. First was, I think if you look at the way the government has been trying to control the outgoing of dollars, they've over the last couple of years tried introducing TCS to make sure that the dollar outflow does not go.
TCS is tax collected
at source. So what happens is, as Indians, we might spend money outside for medical infrastructure, for education, for travel, for investment. So what the government did earlier was added something called as tax collected at source to discourage you to send dollars outside. They've kind of learned probably and taken a step back. So on investments, there is no change, which means in investment, you have a limit up to 10 lakhs. So if you invest up to 10 lakh rupees, then there is no TCS in investments. But if you go above 10 lakhs, let's say you go to 15 lakhs of investments abroad, then on 5 lakh rupees, you have to pay a 20% TCS, which is 1 lakh rupee. Now this stays as it is, but on the other 3 fronts, which is tour travel, education, medicine, they've reduced the TCS. So in tours and travel, it used to be 5 and 20%. They've got it down to 2% flat. And on medical and education also, it used to be 5%. It has come down to 2%, which is good. The second thing that stood out for me was buyback. So what happened in buyback was whenever there is a buyback transaction that is happening, the tax to an individual is at the slab rate, or like you call it, the marginal rate. So if you are in the 30% tax bracket, you will have to pay 30% tax when the buyback happens. But now they've reduced this to capital gains, which means if the buyback is happening after 1 year of you holding, you will now pay 12.5% versus 30% that you paid earlier. So I think these were 2-3 things that I thought that probably instead of nothing, these were 2-3 things that happened in the taxation space.
Okay, so that's on taxation. A couple of positives, of course, was on the fiscal deficit glide path, right?
Yeah,
They continue to maintain that at
absolutely.
4.3% of GDP for FY27. So one thing is for sure that the government is choosing to focus on the fiscal roadmap.
Yes.
That is one positive. But I guess the market has moved beyond that because the market has other worries around, right? Whether it's global geopolitics, its own fundamentals, etc. But on the fiscal deficit, anything interesting from a market POV?
Look, from a market POV, I think what happens is if government maintains the fiscal prudence, then over a period of time, the government borrowing should come down, which should effectively, over very long term, reduce the interest rates in the economy at large, and should also help strengthening the rupee. Right now, these are all very, very long term measures. How they pan out is a matter of time, but the numbers which government has put out are very, very realistic. So at 10% nominal growth seems to be a good number. If you see last year, the whole problem of market was that the real GDP growth was at 8.2. However, the deflator was only 0.5, and there was no nominal growth in the economy. And hence, the P multiples of the markets were getting derated. Right. So if the nominal growth comes in, you have a reasonable amount of inflation kicking in, then perhaps the markets have some cheer going forward in terms of the multiples again coming back. Right. On the other part, if you see the government borrowing numbers, they're also pretty realistic. The Capex number which government has put out is extremely encouraging, Sonia, and I think that's been the hallmark of this government for last 3-4 years, that they've continuously focused on Capex. Having said which, the number in percentage terms is only around 9 odd percent or something like that. But it again, government is trying to do whatever best their fiscal allows them to do, and simultaneously also pushing the private side to increase the Capex from their end. Right. So if that at all happens, then I think there is a whole kick-off or rub-off effect which will happen in the economy, and perhaps you will see some green shoots emerging, and maybe second half of the year you can again start looking at the positive sides of these long-term measures. So
Okay, fair enough. So FY27 public capex has risen to 12.2 lakh crores
Yes.
from 11.2 lakh crores earlier.
Absolutely.
That's for FY27. And also you have the defense capex has
Oh
gone
yes,
up.
so defense capex has gone up by 21 odd percent,
Yeah.
which again is a very positive sign. And I think the geopolitical environment in which all of us are living today, you have no choices across the globe. Everyone is kind of hiking their defense expenditures. So yes, from that perspective, that's also a decent number, and perhaps defense companies should. And these are all dynamic numbers,
But
honestly.
the problem here is defense stocks have rallied a lot. And both of you, you all have this expertise in mutual funds. So do you recommend people still get into these thematic funds like defense funds? Because those were recommendations that did very well in the last, if you take a 2-3 year horizon, right? Are you still recommending that? No?
Um, in all honesty, I think sector funds or thematic funds are actually for very, very, very sophisticated investors. And I say this with a lot of experience in the past of how I've seen sectors not come back to the price at which you bought for 10 years. Right? You look at infrastructure as a story, has always been a great story in India, and all. In every budget, you will see that there is so much of money spent on infrastructure. But does that translate into the stock price moving? The answer is actually a no. Right? So thematic investing or sectorial investing for me is a double-edged sword, because you will have to actually be able to time your entry and exit both correct. You cannot time one of them correct and expect that your call will go right. Right? So you have to time the valuation at which you enter also, and very specifically when you exit also. Because if you don't exit, then you don't end up making money, because these are cyclical sectors and you don't know when the cyclicality will play out in your favor in the future. So I would rather, suggest people not to kind of do thematic or sectoral investing unless you are sophisticated yourself, or you are guided by somebody who really understands and knows when to help you to exit.
That's true. I mean, in my, experience of investing, I've never put my money in a thematic fund because you can't time the entry and exit of a thematic fund for sure. Okay, now there is something, since we're talking sectors, right? There's been a push on for data centers that has been given. And, this whole data center theme has been playing out really well in the past 1 to 2 years. But just tell us what exactly has come out. And as a retail investor, how do you look at it?
Look, I think that is by far the biggest positive measure which comes out of this budget, honestly. Though it's pretty long term in nature and it doesn't impact everyday life right now. But I think this is one thing which will kind of help shaping country's future 20 years hence, right? So, and they've also put out a very bold number of 2047 saying up till then, they are giving tax rebates to any global companies who are wanting to set up data centers providing cloud services in India, which is a massive step, right? So a lot of these global biggies now wanting to come and set up data centers, the GCCs in India. This is a great employment generator. This obviously kind of helps fortify your currency again, because a lot of foreigners bring in a lot of money. It requires a huge amount of capital expenditure in the country to be able to set up these GCCs, right? The GCCs are power guzzlers. India is a low cost power producer. India has good amount of talent available and good amount of AI resource base also. So this will also enable the country to develop that AI skill set or those low cost AI employees basically, which can then work with these GCCs. So to my mind, I think this is one of the biggest steps which this government has taken in this budget. We will only get to see the overall impact of this in coming years. But yes, I think this has the power to single-handedly shape the fortunes of many Indians going forward.
So clearly, what the government is trying to do here is to get a lot of foreign capital in to these sectors, right? But do you think that's enough? I mean, these tax holidays are enough for foreign capital to come in?
Look, a 20-year tax holiday, Sonia, is a very big assurance and a pretty large, long pathway for these companies. Along with this, they have also given safe harbor to IT-enabled services, and they've also announced quite a lot of measures of safe harboring, basically increasing the limit from 300 crores to 2,000 odd crores and those kind of things, right? So my sense is overall, the outlook of government is very clear that they want foreign companies to come into the country, set up systems, set up GCCs out here, provide local employment and get in foreign capital, right? So this is like a boost to local AI ecosystem in the country.
I think, Sonia, if I can add a point to
Sure.
this, they very categorically mentioned that while a foreign investor can come and set up those data centers here, they can still provide cloud services to global clients and not just in India. But the tax SOPs are based on you being able to provide it to India as well through India resellers. So I think what that does is not only brings you capital, but like he rightly said, it also builds an ecosystem around this, which is not only capital but employment also in the longer time frame. And also AI, we've seen how much or discussion around AI in general is also happening globally. So data center is one thing that they've done to AI, but if you look at the commentary made around electronics, semiconductor, right, all of this is in the right direction, that India probably wants to become, what do we call, the factory of AI,
the manufacturing hub
for AI in India.
It seems like a pipe dream though at the moment, right? With the way things are going. But yeah, I mean, you can start somewhere for sure. The other thing is the reduction in buyback taxes, right? I mean, we spoke about that ad nauseum, but just to understand a little more in detail, what is this and, how does it really benefit an investor?
So technically what happens is, let's say if you as a company allow or call for buybacks at a certain price, right? And I tender for that buyback. And let's say I've made capital gains. So let's say my buying cost is 100. You buy it back from me at 150, which means I've made 50 rupees of capital gains. Now, if I'm in the 30% tax bracket, I was until now, I was expected to pay 30% tax on this 50 rupees, which is 15 rupees of tax. But now what happens is, now they are proposing that we will change this to capital gains, which means that now the 50 rupees of capital gains that I've made, and if I've held it for more than a year, I will only pay 12.5% on that 50 rupees, which is a stark reduction for somebody who's kind of being able to use the buyback. Or probably I'm assuming that now more and more buybacks will actually start happening, because until now, this tax was a big reason why a lot of things were not moving. And Infosys is a point in case. The founders decided not to give money in their own buyback, right? Also, there is another thing that was very interesting, and it is not from a tax perspective, but more from an operational standpoint. There are a lot of people So last year what happened was you increased the limit to 12 lakh, 1275, right? Now there are a lot of people who are not in the tax paying category. Okay. I'm just explaining this in this context. Capital gains were not part of the 1275, but just to try and put this as a context, a lot of people are not in the tax paying category. But when they invest on their dividends or on their interest, companies or institutions cut a TDS. Now it's a hassle. Imagine I'm not in the tax paying category and I've invested across 20 stocks, right? I was expected to reach out to those 20 companies and submit a form 15G and 15H, whatever is relevant, to tell them that don't cut TDS on my income because I'm not supposed to pay tax. Now what they've done is to make this operationally very easy, and specifically for senior citizens, is they've suggested that now you just put up your 15G, 15H to NSDL, CDSL, and they will take care of reaching out to the companies at once. So now instead of reaching out to 20 different institutions at your end, just give it to NSDL, CDSL, and they will take care of it with all the companies and they will not cut your TDS.
Okay, so that's a good thing.
Yes.
Okay, great. Fine. Now I want to talk a little bit about the markets before we end. So just going to wrap up on the budget side. Anything else? We spoke about defense, Capex, infra, buyback, fiscal deficit. Anything else that we missed out which could be a big element from the budget?
There are certain googlies, and those are very smaller tweaks in the fine prints, and which I've also just read. One is on the SGB, which was a very, very big thing in the
Sovereign
market.
gold bonds.
So if you have bought SGBs in the secondary market, which means you were not a participant in the primary issuance when RBI actually floated the SGB tranche, and you bought it from someone else on the exchange, then at maturity, now you will be paying complete tax. So previously, SGBs were tax-free at maturity. So there is a whole lot of tax change on the SGB. So investors will have to take a note of that. That I think is a big one. I think there is one more smaller googly, which is that there are a lot of market participants who borrow funds, which is line against mutual funds, lines against stocks, and advances against bonds and everything. And they invest those funds into stock markets again. So previously you could set off the interest expense on these borrowings against the dividend income which you receive from investing into stocks. So now that set off has gone off and you will have to pay taxes on the, so that benefit has now been taken off. So these are smaller things. I think one thing which Kirtan's already mentioned, which is a second order effect of your STTs going up. Yeah. I think the arbitrage funds will become less important in your daily lives, which was getting bigger and bigger as a parking investment tool because debt was getting unattractive because of the taxation. So arbitrage also takes a little bit of a hit, and consequently the other categories like your equity savings funds and some amount of hybrid funds which use arbitrage, and even the newer category which is SIF, which is also predominantly based on long short derivatives and arbitrages and so on and so forth, might take a hit. So this category has just gone live. It's just been born. The new age baby has been given a vaccine which is not so conducive. So my sense is we'll have to see the overall impact on the returns, but yes, these are minor hits which people will have to bear with.
Got it. Okay. And these minor hits become major at a time when the market is already falling, right? So that was my question. Since you guys, you have been in the mutual fund business for so long, and mutual funds have in the last 2-3 years given no returns. People are really disappointed, almost disillusioned by equities, right? The other day I was speaking to someone who told me they've transferred their entire mutual fund portfolio to silver. And I was shocked because
You should speak to them today.
Yeah. This was before the crash, by the way.
Okay.
And I was like, people are so disillusioned that they're ready to erode years of compounding because they want to chase the next euphoric.
Yeah.
But the fact of the matter is people are not making money in equities in the last 2-3 years, right? So Kirttan, your thoughts. Is it going to be like this for a while, or do you think that, and all of us have a confirmation bias, let's be honest, we are all investors in mutual funds, we all have been in this industry for years, so maybe our view is a bit clouded, but your thoughts?
I think, Sonia, I'm going to use something that Ashish very prominently uses. Market volatility is actually a feature and not a bug. Okay. Had it been like an FD which gives you a linear line of return constant over years, it would have not been able to generate higher returns for you. The volatility is the prime reason why equity is able to give you higher returns, right? So the problem is the recency bias. So today people are talking about gold and silver because gold and silver has done whatever it has done. But if you take them back to history, how many people do really know that gold has a 9-year or a 7-year cycle? So in the last 25, 30 years, there have been 3 periods where gold took once 9-year and another 2 times 7 years to come back to the price that it was 7 or 9 years back. Silver is even worst. I mean, silver has had situations where silver has fallen 80-90% twice in the history. The problem is, like I said, recency bias. Today also that you and I are talking, most people want to invest in global markets. And the reason is that South Korea gave 80% last year, Latin America gave 45%, and everybody else across Japan, China, Europe, US, everybody gave 20-30%. But if you look at India, for that matter, there are 2 ways to look at what we are seeing. First is, yes, the Indian markets didn't do very well over the last 1 year. The other way to look at it is that we did so well prior 4 years that we should be happy that we did not lose money this year. Equity markets, Nifty level, since 2015, there has been not one single year of negative return on Nifty. 10 straight years of positive return.
Absolutely.
Right. So you might be upset that you've made less, right? But
You've not lost.
Yeah.
my submission is that you should be happy that you've not lost, right? Because the only constant in the market is mean reversion. If you've gone up for 10 straight years, right? This is a small mean reversion to try and make sure that now you've gone through a time correction, and if
And asset prices are very inflated, right? So mean reversion generally helps the
Absolutely.
froth come off.
And so now that you've had sideways market for the last 12-18 months and there has been a time correction, I think if earnings pick up, you are in a far better situation than global markets that ran up. So the problem is, now if you try and invest in gold and silver or in global markets, right, it'll be counterproductive versus you should actually start looking at India.
Equities. You should be looking at equities. No, I'm 100% with you. And I've seen so many market cycles. I was just looking at some of the, you have these pictures, a decade old pictures, and everyone's posting their 2016 pictures. I was looking at what I was doing in 2016. Exactly at this time, I was stressing about the Nifty at 7,900. At 7,900, because the budget had happened and there was talks of LTCG at that time, and the market fell to 7,900. And today we are at 25,000. We are 3x in the last 10 years, right? And at that time, it seemed really big because there was so much happening in terms of the Fed and the budget. Same story. Different Fed governor, different finance minister, different budget, but same story.
No, so many times I think we forget from where do we start from, right? So when I started my career, the income tax slab was at 1 lakh rupee. In 2005, it was at 1 lakh rupee where you started paying taxes. So today, at even 12.75, which Kirttan said, you're not paying any taxes, right? So the world has changed many times over. Nifty has become Sensex has become Nifty of those days. So it's grown, right? There is a story of compounding, and this story can't be linear at any point in time. And the fact of the matter is, anyone who is born in this century has only seen 4 negative calendar years thus far. Which is like a great scenario to be. Out of 26 years of your life, if you've just seen only 4 negative calendar years, then you can't call it a bad market. Equity markets will obviously test your patience at times. And 18-month of time correction, Sonia, to my mind, if that rattles investors so much, then honestly they have to be reconsidering their overall asset allocation. If you were in Nifty stocks, if you were in large caps, if your asset allocation was right, you're not the ones who were hugely disappointed last year. Yes, there was no reason for you to cheer, but you wouldn't be hugely disappointed. If you were the ones who were heavily loaded in small caps and micro caps and were doing all kinds of sectoral things, then yes, you will have all the reasons to be blaming and cursing the government and the markets and so on and so forth, right? So it also depends on your own individual asset allocation setup, how disciplined you are, and perhaps how you're viewing this game. It's not a game of 1, 2, 3 years. It is a game of decades, right? So you have to stay put in the market for a decade at least to be to be completely aloof of these kind of cycles and say, okay, these are all part of the game, and I will keep riding these as they come.
Absolutely. I completely agree with you. Also, I feel like in the last 10 years, a lot of new asset classes have come out, right? I mean, there's, of course, cryptocurrency, which has come. People do make money, people lose money as well. But I think with equities, what happens is, you will not, like in a single day, you won't lose 30% of your, unless there's a, path breaking event, right? Now, we saw that happen with silver, for example. In a single day, people lost 30-40% of their gains. And that volatility is what I keep telling people, right? Making money is, if it was that easy, everybody would make money.
Absolutely.
I mean, if you are saying, oh, I bought silver and I'm going to ride it, you have to be ready to even digest that 30% fall and then say, okay, you know what, it's fine. I'll deal with the 30% fall just like I dealt with the 100% rise in a month. So that I think it's different strokes for different folks.
I'll tell you, I think the bigger problem here is that when we zoom out and say that silver made 200% return or 220% return, whatever, in the last 12-15 months, the point is, how many of us would have actually made that?
Yeah.
It's not just the market falling, it's also the market going up. So what I mean is, let's say if you invested 50 lakh rupees in silver and in a matter of 6 months, if it became a crore, how many of us held on to it? So it's not just market falling, which is testing our behavior. Market going up also tests our behavior. And which is why it is said that investors don't end up making the returns that the asset makes, because we can't control our behavior. No. So when you zoom in, the chart always looks like this. It's only when you zoom out, the chart looks like this.
Absolutely. And I think one more thing, before we wrap up, is that when you see a market, when you see a 50% rally, right, you're also talking about the previous 10 years where silver has done nothing.
Correct.
So the opportunity cost you would have lost in equities if you had put your money in silver.
Completely.
Then who has gained? Eventually, equity guys did not put their money in gold and silver, and that's a fact. Nobody made money in gold and silver in the last 10 years. Asset allocation also was always recommended to be 10%, at best 10%, not more than that.
Absolutely.
So equity guys have missed out on the silver and gold rally entirely. But that's okay, because when silver and gold did not rally, they made money in equity.
So look, you can't be everywhere at all points in time. In investments and in life, you will have to forego many things.
Correct.
Basically, there are many good things which pass you by, and you can't be grabbing on all the opportunities and regretting that, I've missed these many opportunities. Same is the case with gold and silver kind of a FOMO. And plus, my other take, Sonia, out here is that if you see an asset class giving you unrealistic returns in a very short span of time, that itself is a sign of, it's a great red sign, right? So you have to be very, very cautious. Anyone entering silver, getting dazed by the stories of industrial production increasing, so on and so forth. Look, to be very honest, when silver rallied in 2001, it was the same industrial production story, because silver was then being used in solar cells. It was a new invention that solar power was overtaking the fossil fuel power, and silver will be the new source of energy, and it will power all the solar batteries and so on and so forth, right? And even previously, in one more cycle, it was about industrial usage of silver getting increased. So one has to actually question that how can an industrial usage increase when an asset class was at $30 an ounce and it reaches $130 an ounce within a span of 12 months, as to what the industrial usage has changed from. So from whatever 250 million ounces, they've increased to 350 or 400 million ounces of industrial usage of silver. That doesn't mean it completely changes the narrative, right? So you have to actually do a little more deeper study than just go by what the market is saying. The problem with gold and silver has been that this is an asset where everyone thinks he is an expert. Right, because it's a common expert. It's a common asset at every household, right? Every household has silver and gold, and people from your parents to your neighbors.
Is it, right? You just buy gold and you keep it.
Absolutely, and they all have a view on it, and they all have a view which you can't counter. So it becomes extremely difficult at times to talk logic. But yes, you can't be everywhere at all points in time.
I think I'll give you one very interesting data point that I was reading, and it's slightly dated, but it fits so well in our conversation on silver. This is mid-November that I'm talking about. I read this report by this institute called the Silver Lake Institute. And they do research around silver and all of that. While all of us are talking about industrial use of silver and growth and all of that, that report starkly said that in 2025, demand for silver has actually gone down 4%. And ETF demand has gone up by 225%. Now this is November. Imagine the rally that happened in December and Jan. How much would the ETF demand actually have gone up by? So I think the silver run is more investment demand than industrial demand, in all honesty.
Okay, FOMO demand.
Absolutely,
Yeah.
absolutely.
Okay, guys, thank you so much. It was a really fun day, and thank you for taking out your time and speaking to us, being here with us, watching the budget together. Hopefully, it'll be an annual exercise, but thank you so much for being here.
Thank you.
Thank you for having
Always a
us.
pleasure.